when you have a dealing range, and we define that from this high here, and it's dropping down back to a PD array over here. This was a stop run. So we nixed this. We don't even pay attention to this candlestick. All that was a little bump to take that high, and then price went lower. It drops back down to a discount. I'm looking at this high here and the bodies. Because this wick is just like this one. It's doing damage. I'm going to go back to the bodies here. And I showed you by drawing that out in time, that's the return to it here. And then we have a shift in market structure. You can define it with this high here. And there's nothing wrong with that in this case because we are expecting what? A large range day to deliver today on Friday because Thursday was an inside day. Using this one, it qualifies it even further because when it trades above this one, it's one candle and then the next candle trades above that high. So it shifts market structure bullish. So any retracement back down into this inefficiency here should be viewed as what? A discount array. Now, because this high is the highest high in this retracement, in a market that's bullish, we can grade that price swing. Here's your dealing range, okay? And equilibrium is the halfway point right here. So ideally, your best entries, lowest risk, highest yield in terms of R multiples, is going to be entered on a long at or below this line. Pyramiding has to be limited to this price level here or lower. Now, how can we use this information to pick the right fair value gaps? How can we use this information to pick the right order blocks? That's our bias, it's bullish. So that means we're going to be looking for draws on liquidity for buy side. We're not interested in shorts. So that means you're going to look for bullish order blocks. It means you're going to look for bullish breakers. It means you're going to look for bullish fair value gaps, or you're going to look for fair value gaps that were initially characterized as what would be short selling or premium that's going to be broken and then treated as an inversion fair value gap. You see how everything changes to, these are usable PD arrays. These are reference points that now you can suddenly build an idea or an expectation around versus every down close candle should be an order block. It's not. It's not. So at 8:30, the algorithm kicks in whether there's news or not, but we had medium impact news driver this morning. So at 8:30, the market trades into our discount array, and then we wait for what? Displacement. We don't just go down here and start buying just because it's trading there. Let the algorithm tip its hand to you. Let the market say, listen, I'm going to show you what I'm about to do. Pay attention. So the market goes above the short-term high here. What makes this candlestick important? It's lower high here and it's lower high here, so that's a swing high. So when the market breaks above that, that's a shift in market structure. So we can see it as such. So that's a shift in market structure. Go back and look at Model 2022 mentorship videos and you'll see it's very similar to that. And then it displaces higher, and then we have another swing high. This candlestick's high is lower than that one, and then a lower high on this one. So there's a swing high there. And it broke both of them, leaving what? This buy side imbalance, sell side inefficiency. A portion of the order block or a portion of the fair value gap must, listen folks, listen, okay? It must be at or below the quadrant level. Here's your lower quadrant level. Here's your fair value gap. Is this fair value gap at or below the lower quadrant? Yes. That means that this fair value gap is a proper candidate to be long when you're bullish. When time, 8:30, spooling at 8:30, that's the only 30-minute delineator for a macro. 8:30, whether there's news or not, the algorithm will start spooling. If it doesn't start spooling and running, then you just simply wait because it's telling you that it's waiting for the 9:30 opening bell. So what happens if you're anticipating something here and just meanders around or goes lower? Do nothing. Sit still and wait for the 9:30 opening bell. But because I built the case around everything I'm talking about today, see, we're already inside of the equivalent of 2 chapters in a book just with this live stream. Just this live stream talking about the impacts of knowing how to use the economic calendar, knowing how to use the day of week phenomenon, understanding the pools of liquidity and the PD array matrix, and how to now use that information and define which order block, which fair value gaps are the one I trade off of. By defining this with the quadrant level here, Your fair value gap or order block, which is this down closed candle right there, is that below that quadrant level? Yes. Is this fair value gap at or less than this quadrant level of this dealing range? Yes. Now watch what happens. The market trades down. We have a little bit of a mohawk. That's fine because we have an order block there. That order block right here. Why am I using that one? Why am I specifically using that one? Because it has the lowest down close in with a body. So the body's projection lower, it's lower, and we don't use this wick. This is your order block right there. So half of that order block is a mean threshold reference point. It's not consequent encroachment. Consequent encroachment is gaps or inefficiencies or wicks. Okay. When it's a candlestick body, in this case it's a bullish order block, half of that range is mean threshold. That price is 452.75. What's the low of that candlestick? The fucking low of 452.75. Folks, that's perfection. But that's supposed to be buying and selling pressure, right? On the next candlestick, right there, what's the candlestick's low there? 20,452.75. Not one deviation off by one tick less or above. That value perfectly delivered. So the market does what? It rallies back up, and look what it does. It delivers into this volume imbalance. See that? So this volume balance, it delivers it. What's it missing? Buy side and sell side delivery. So it lays a body up in there. So it buries a body inside that volume imbalance and then drops right back down into what? That swing high here. Rallies back up, leaves the lower quadrant, trades up to equilibrium, meanders around in here, and then causes what? Another displacement. What is this candlestick right there? What is that? It's a fair value gap. Well, ICT, why didn't you use this one? Didn't you use that fair value gap, ICT? Why aren't you using that? Because isn't that a fair value gap? Isn't that a buy side and sell side efficiency? Ain't that the thing? Ain't that the thing? No, because where's that? The majority of the body of that buy side and sell side efficiency is what? Above that quadrant. Oh, starting to make sense now, isn't it? So here we have what? Equilibrium. We're at that we're at that precipice where if you're building a position in all this down here, pyramiding, like you've seen me do many, many times, we're at that halfway point of that dealing range. So that means you have to do all of your business at that price range here or less if you're going to be pyramiding. Otherwise, if you start adding up in here or above it, you're really just tossing good money after potentially you might see a retracement. Even though it's low resistance liquidity runs, meaning that we're not getting a whole lot of deep retracements. What's a characteristic of low resistance liquidity runs? Down closed candles will support price higher, and inefficiencies will leave a portion open. Is that hard to remember? I've already said it before, but you probably forgot. But now this is the time when you write it down in your journal. Every day, when you first start your day, have that written down in front of you on your notepad. High resistance liquidity runs are going to see a lot of give and take back and forth, and every fair value gap will be closed in. Remember, if it's spending a lot of time in the inefficiencies, what is it doing? It's telling you what? We're inside of high resistance. That means it's going to be problematic for you. You're not going to be comfortable in it. It's going to be back and forth price action. Don't run your stop loss up real quick to break even. Just let it move or don't trade. It's that's the characteristics with it. So in here, we are in close proximity to equilibrium from the dealing range high, dealing range low. We've already accumulated down here, rallied up, equilibrium, retracement, and then displacement here. So we are seeing this fair value gap dead in the middle, consequent encroachment. We can now take that also. So because it's laying inside of equilibrium and half of that gap is basically overlapping that blue line, which is equilibrium of the dealing range when you're bullish, how could you use that? Now you can try to put a limit order to buy right at the midpoint, trusting that it's going to leave the lower portion open. Notice how it left this down here open? What is that? It's a breakaway gap. This is a tradable fair value gap. But because the consequent encroachment of this gap, it's overlapping with the equilibrium price point or middle of the high to that low. So it's a convergence of two factors of equilibrium or midpoint. So this is where a institutional order flow entry drill would be optimal because you would expect what? Only a partial entry into that, that blue shaded area or fair value gap. So this is institutional order flow entry drill. You can use the upper quadrant of this range, and that would be done like this. It would use that price plus one tick, that 462 and 3/4 plus one tick. And that would be your entry. That would basically give you a very specific, not a zone entry, a very specific price level that would constitute an institutional order flow entry drill. Institutional order flow entry drill is a entry model where you're expecting a fair value gap to be traded into, but not fully closed in. So low resistance liquidity run entries in here, low resistance liquidity run entries here, and then this is a gap that is what? Below the upper quadrant. And this is where I would use to see if I'm on side. Now, you can take that and enter on it. There's nothing saying that you can't use that as a model. I'm not saying that I'd be comfortable doing that. I could do it. Your trading ends on the entries here or less. Anything above it, you're just using it for management purposes. So when this fair value gap forms, this is a valid fair value gap, but it should not fully close in. Why? Because we're in low resistance liquidity run conditions. We're in an early session of a potential large range day that's bullish, and we're at the quadrant, upper quadrant, and less. See that? So what does that create in here? This candlestick's low. That's an institutional order flow entry drill. That's an institutional order flow entry drill. That's an institutional order flow entry drill. Leaving what? Portion of the range open. That is telling you continuous feedback that yes, down close candles consecutively, that's an order block. Draw that out in time. Hits it. Does it support price? Yes. In and of it by itself? Nope. Half of this gap at equilibrium and an order block, this portion should stay open. It should not trade back down to this one because that's a breakaway gap. All those things are signatures and characteristic of low resistance liquidity runs. Folks, it's flawless. That's why when you watch my executions, you're like, what in the hell? And you see my stop losses and they're ultra tight and I'm sitting comfortably and they're getting real close to it. I'm not worried about it. I'll add right there. When you enter in here, your stop loss can be just below this candlestick's high because it's not going to go down to the lower bottom of that fair value gap because we're in low resistance liquidity runs. The algorithm is controlling this. So if you know what the mechanism is going to be when it is seeing these things based on defining your dealing range, knowing where equilibrium is, if you're bullish, you're buying at it or below it, in every fair value gap, or in this case, order block. Isn't this an order block? Down close candle, down close candle, two consecutive down close candles. That's all one range. It's doing what? It's delivering price lower. Does that down close candle support price going higher when it comes back down to it here? Yes. Then price goes where? Higher. Down close candles here. 1, 2, 3. And then it creates that final institutional order flow entry drill like it did here in this range here, going right below the high of the fair value gap. Same thing here. This candlestick's low. That's the high of this blue shaded area or fair value gap. So it's trading back down into that. When we're seeing price trade down into it, this candlestick here, isn't that an order block? Isn't it a down close candle when price is moving higher? Inside that candlestick's range, it's trading down into it. And it's rare that it does this, but sometimes it will. It'll trade to the low of the candlestick. I don't like that. I would never enter on a trade like that. I want to see half of a bullish order block, the mean threshold or higher to its high. I want to see price use that portion of it to trade down into and then repel price away. When you're looking for dojis or tails beneath the candlestick, like we're seeing here and here, those are forming inside order blocks or inside fair value gaps. When the order flow is bullish, you can anticipate these things forming. That's why when you look at my entries, I'm always entering on the very lowest candle or the one candle before or the one candle after the lowest candle when I'm bullish. Now the market then leaves this range and breaks above the dealing range here, and then we're going into what? into that 9 o'clock hour.